We ready to go?
Yeah.
Okay.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to our webinar. The topic for today's webinar is foreign exchange for corporate finance teams. This is Jack Lobeck with Battelle Battelle, and I want to remind everyone that questions are certainly welcome. You can submit your questions by typing them into the box on the screen and sending them. We will attempt to get to answer all of them during the webinar. We will again be offering CPE credit for the program, and as such, we will be giving CPE codes 3 times during today's presentation. If you would like to receive the CPE certificate, take note of these codes and return the completed CPE form to Lynn Keenley in our office. I would like to welcome today our guest presenters. First, Mark Wendling, Managing Partner with Bannockburn Securities, LLC. Mr. Wendling has over 18 years of experience in currency risk management and in working with corporate and institutional clients on foreign exchange-related issues. Prior to founding Bannockburn Securities in 2009, he was a Managing Director of Capital Markets Trading at Fifth Third Bancorp in Cincinnati. He's a graduate of the University of Dayton and is a Chartered Financial Analyst. Our second presenter is John Sherman, a partner with Bannockburn Securities. Mr. Sherman has over 21 years of commercial banking experience and has managed the international department of 2 large regional banks prior to joining Bannockburn in 2011. These teams focus on foreign-owned corporations or those with extensive international operations. His expertise includes foreign exchange, letters of credit, and cash management. And he also is a graduate of the University of Dayton. Well, Mark and John, I want to welcome you and thank you for taking the time to impart some words of wisdom with our friends today. So
thank you for having us. We appreciate the opportunity to be involved in your CPE program, and sometimes it's a little difficult because foreign exchange is such a broad subject area to put something in for everyone's, I guess, level of knowledge for foreign exchange. So if anyone has any questions, we're actively watching those pop up here, and if there's any questions outside of the material that I've got here, I know what's going on in Europe with the euro is very timely in today's market. So if anyone has any questions about anything related to sort of the markets in general, we're happy to answer those as we go through the program. This very basic table of contents, we've broken this really into 3 buckets today. We're going to talk a little bit about the market in terms of how things are quoted, how things are priced, who is participating in the foreign exchange market, the products that are available in the market, not only to move funds, but also to hedge risks that companies might have throughout their normal course of business. And then we move into managing those risks that the clients may have. Starts with budgeting and planning, sort of moving into the types of exposures and cash flows that they might have in running their company, and then in setting up hedging programs. You know, very important to that is looking at the budgets and the plans, and then knowing what your risk tolerance is over the course of the next few quarters or into the next year or whatever your time frame may be. And then lastly, just touching a little bit on sales through exports, certainly emerging markets, international business companies are looking for opportunities to grow their sales. Those markets are growing much faster than the United States. So we wanted to talk a little bit about what to look for in terms of contracts when you're talking to clients about, or potential clients about pricing, price list, projects. And then if you do get into a situation where you're making some sales in a different country, how to settle foreign receivables if you are receiving other currencies outside of the U.S. dollar. And to start, just very basic, there are 2 ways to quote exchange rates, and sometimes it can be a little bit confusing in terms of whether it's in dollars per foreign currency or whether it's in foreign currency per dollar. So I wanted to break this out into two sections here. The first quotations are called the direct method of foreign exchange pricing, and basically those are quoted in U.S. dollars per foreign currency. So if you look at the euro, the sterling, the Aussie, or the New Zealand, as I've got on the screen, those are very simple to learn and very simple to use in that if you've got $1.37 in your pocket, you can buy 1 euro. If you've got $1.57 in your pocket, you can buy 1 pound. So for new employees, new trainees that we have at our office, we always like to start with these four currencies because they're very easy to understand and learn. If the euro exchange rate's going higher, certainly that means there's more U.S. dollars per euro. It's very easy to understand. In terms of going backwards and forwards in terms of direct currencies, if you look at the 100,000 euros we have there about halfway down the page, if you're starting with euros and you want to go to U.S. dollars, it's a straight multiplication. So 100,000 times 137.15, that'll get you to the 137.150 U.S. dollars. If you're starting with U.S. dollars and you want to find out how many euros that you have, that's a division, as you can see over to the right. $250,000 divided by 137.15 will bring to you how many euros that you actually are going to end up with. Outside of those 4 pairs that are quoted directly, all other currency pairs, and there's over 100 other ones that are traded other than the 4 direct on top, those are all quoted using what's called the indirect method, which means foreign currency per U.S. dollar. So again, an example at the bottom, how to go backwards and forwards with a given exchange rate. If you're starting with a Mexican amount, you've got 15 million Mexican pesos, and you're wanting to get to U.S. dollars, you would divide by the rate of exchange, so 15 million divided by 13. That will bring you to the 1.1 U.S. dollars and some change. If you're starting with a U.S. dollar amount, wanting to figure out how many Mexican, that would be a multiplication. So as you see at the bottom, 650,000 times 13, that will bring you to the 8,450,000 Mexican. In terms of other currency pairs, what we call cross rates. So any other 2 countries, you could actually come up with a cross rate of exchange between those 2 countries. And this becomes important, for example, if you're a U.S.-based company that owns a Swiss subsidiary and that subsidiary is selling into the Eurozone, the Euro-Swiss cross becomes very important. As a seller of your product, if the Swiss franc is very strong, it's going to become much more difficult for you to sell into the euro. So I wanted to at least give you guys a little bit of a flavor for how cross rates are set up, and the most traded crosses are those 3 that I've got listed out. Euro-yen, Euro-sterling, and Aussie-yen are 3 crosses that are traded a lot in the marketplace. Convention for how these are quoted calls for a direct currency to be quoted first in the pair if crossed against an indirect currency. So if you've got euro against yen, euro against Canada, euro against Swiss, euro against Mexican, or if you've got sterling against Swiss or sterling against Canadian, the direct currency is always going to be the first one quoted. Convention also calls for the euro to be quoted first against other direct currencies. So if we're talking about the euro, if we're talking about the sterling, if we're talking about New Zealand and Aussie, the euro is always going to be the first one that's crossed against that other currency pair. Some sample math here again. If we're talking about euro-yen and that rate is trading at 105.50, this is yen per euro. And this is another handy way to know how what currency is quoted and what amount. So it's always the second currency quoted per the first currency. So euro-yen, for example, is always going to be yen per euro. If it's Aussie-yen, it will be yen per Aussie. If it's sterling, it will be sterling per euro. So that's kind of a quick way to go backwards and forwards in terms of what currency is quoted per which one within the exchange rate. Simple math, if you're starting with 1,000,000 euros and you want to end up with yen, That's a straight multiplication. So if we've got 1 million times 105.5, you're going to end up with 105,500,000 yen. And if you're starting with yen and you want to end up with euro, that's a division. So if you've got 75 million yen and you divide by 105.5, that's going to give you 710,900.47 euro. Another example, sterling Swiss at the bottom. If that's trading at 138.40, again, it's the second currency quoted per the first currency. So this is Swiss for sterling. So if you've got 450,000 pounds to come up with a Swiss amount, you do a multiplication. If you've got 2,300,000 Swiss, if you want to get back to the sterling amount, then you have to do a division. So the 2.3 million Swiss divided by 138.40, that will give you the sterling amount.
Take this time to give the first CPE code, and that will be 17. I'd also like to just let everybody know we're having a little technical difficulties with the questions coming in, so don't know that I'm going to be able to pick up the questions coming in. We'll try to work without it, but appreciate. Let's just move forward.
Going on to the next slide, quotations and pricing. In terms of what side of the market you're actually on when doing a trade, sometimes this is interesting to at least have a very basic understanding of. The bid side is the left side of the market, the offered side is the right. So as you see again in those four currency pairs I've got listed, we've got euro dollar, we've got sterling dollar, Aussie dollar, and dollar yen. In the euro on the first line, 137.15 is the bid. 137.20 is the offer. Sterling, 157.50, 157.55. So there's always a bid and there's always an offer in the market. Depending on what you're doing, you're going to be on one side or the other. The distance between the bid and the offer, that can vary greatly. It depends on the size of the transaction that you're doing. It depends on what is going on in that particular time in the market and when the transaction is taking place. As late in the day, for example, if someone were to call in and try to do a trade at 5 o'clock or after 5 o'clock during the week before Asia opens, those bid-offer spreads are going to be much wider. If the market is anticipating an economic release, let's say the employment number is coming out at 8:30 on a Friday, at 8:27, 8:28, the market is going to have very wide bid-offered spread. That's the market's way of saying they don't want to take a trade on before that news gets disseminated in the market. Holidays in different countries. Really the only day that our market is closed globally is New Year's Day. It's open on Christmas in Japan, for example. So depending on where you're trading, when you're trading, what's happening in the market, those bid-offered spreads can vary greatly. A little bit further down on this slide, we're talking about direct currencies. If you're the buyer of the foreign amount, you will be on the offered side of the market, while a seller will be on the bid side of the market. So in our top mathematical example in euro, if you would like to come in and buy euros, you're on 137.20. If you'd like to come in and sell euros, you're at 137.15. And in direct currency pairs, the market maker, whoever is taking that call from you, is either bidding or offering for the foreign amount. So those bids are in euros. In an indirect currency paired against the U.S. dollar, a buyer of the foreign amount will be on the bid side of the market, while our seller of the foreign amount will be on the offer. So in indirect currency pairs, the market maker is bidding or offering U.S. dollars. This next slide, I thought it was maybe instrumental or educational, I guess maybe was a better word, to show how to use points or ticks or pips. Those are all sort of slang that we use in terms of the basis points in the market. The three currency pairs that I've got listed, we've got euro, we've got dollar Canada, and dollar Mexican. The furthest column to the right of the decimal place is where they begin. So in the first example, we've got 5 points. So it's the 0.005. It's the last decimal place where those points are. In dollar Canada, we've moved it up to 82 points. So you can see that the 2 starts in the very right-hand decimal place, 82 ticks or pips. In dollar Mexico, we go to 922 points. That shows that the 9 decimal place is a third over from the right. So just understand in different currency pairs, we always want to start to the very far right when we start to talk about basis points. In the first example, if we start with 137.15 and we were to add 5 points, that will bring us to 137.20. In dollar Canada, if we start with 98.23 and add 82 points, that'll take us to 99.05. In dollar Mexican, if we start with 1307.50 and add 922 points, that will take us to 13.1672. So this will give you just an example if you hear someone talk about pips or ticks or points, how they're priced, where they're located in the exchange rate, and then just some very basic math. The other thing that's maybe educational to realize here is 1 basis point in, let's say, dollar Canada, for example, is worth much more than 1 basis point in Mexican. The Mexican rate is obviously much larger than the rate in dollar Canada, so a 1-point difference in dollar Canada or a 100-point difference in dollar Canada is going to be a much, much bigger cost or bigger P&L swing than it would be in the Mexican peso, for an example. And then using multiplication division with points, there's a very easy way to figure out in direct currencies what sort of dollar difference on different pip levels or different spread levels or different moves in the exchange rate. So if you have €1,000,000, for example, and you've done something where the market's moved and it's costing you 5 basis points, if you just multiply those two together, that will give you $5,000 US. So the points in direct currency pairs, again, back to Euro, back to Sterling, back to Aussie, New Zealand, those points are in US dollars. So any type of point that you're going to have multiplied against a direct currency pair will very quickly give you the US dollar amount in difference. So if you've got a $1 million Euro project and the market's moved 100 points on you, you know right away that that's a $10,000 cost or benefit depending on which way that the rate's moved. If you're starting with US dollars and you've got a $5,000 amount, for example, and let's say that's over €1,000,000, just using basic algebra here, that gets you back to the 5 points. So depending on what you're starting with, you can get into points or dollars very quickly. In the last example, that should be 500,000 US dollars. I think I have Canadian in there, but if you can just put USD after the 500,000, if you multiply that by the 250 basis points, that will give you a Canadian amount. So if you're doing a project or a deal or have a receivable or a bill you have to pay and you know the dollar amount and you know the exchange rate has moved certain number of single-digit basis points or several hundred basis points, if you multiply that out, that'll give you the foreign amount that it's either costing or saving you. So I thought it was important just to kind of show for a lot of you that are doing transactions and you see the market is moving a couple hundred points, what that actually means. There's a very quick way to sort of multiply and divide to get you what you need in terms of what it's either saving you or the additional amount that it's costing you. In terms of US dollar strength or weakness in the way that the rates of exchange move, in direct currency pairs, as the rate of exchange goes lower, the US dollar becomes stronger. And again, this goes to what I had said initially, that it's a lot easier to learn directional strength or weakness in the US dollar with the 4 direct pairs. As you can see on the bottom, if the dollar moves from 160 to 125, clearly it takes fewer US dollars to purchase €1. So that's fairly intuitive to understand. In the opposite direction, in direct currency pairs, as the rate of exchange goes higher, the US dollar becomes weaker. So it takes more US dollars to purchase €1, for example, moving from $1.15 to $1.35. And all of this, I don't believe I put in the information, it's exactly the opposite for the indirect pair. So in an indirect currency pair, as the rate of exchange goes lower, the US dollar actually becomes weaker. And in the indirect currency pair, as the rate of exchange goes lower, or excuse me, higher, the US dollar actually becomes stronger. So on the indirect, which is every other currency, it's exactly the opposite of what we've got here on the slide. Participants in the marketplace, and maybe just to speak about the market for a quick second, it's the largest market traded globally. If you were to add all the stock and bond and derivative notional volume that gets traded in a day, it would still be less than what gets traded through the FX market in a given 24 hours. That amount typically is a little over $4 trillion US in a 24-hour period. the market opens on Sunday night in Asia at about 6 o'clock in New Zealand, and it sort of moves itself from west to east at that point. So you've got New Zealand, you've got Australia, you've got Japan, then you've got Europe will open, and then London, and then New York comes in. So our market's 24 hours a day, starting Sunday at about 6 or 7, and then it closes Friday at 5 o'clock. The parties that make up a lot of the trading in the market, I put them into two buckets. One I call speculators, and the second would be commercial or end users. On the speculation side, that's actually 90% of the trading that takes place in the market. So people that are guessing where they think the exchange rate's going to go. And those traders could be at commercial or investment banks, although some of the commercial bank trading is being limited by Dodd-Frank. But in the old day, a lot of that trading was coming from the banking community. Most of the trading that's being speculated on today would be in the hedge fund world. Those are also known as commodity trading advisors that do more macro trading in commodity and currency space. So 90% of the volume that's going through the market on a day-to-day basis is speculation. The rest is what you guys do, which is trade. You've got products that you guys are importing from another country. You're exporting products into another part of the world, and you're being paid in a foreign currency. That makes up the other 10% of the marketplace. And I've kind of listed off with about a dozen bullet points, certain types of clients or certain types of customers or entities that would have foreign exchange. So if you import or source products from vendors or suppliers, if you're an exporter of products, obviously we just mentioned, and if you get paid in another currency, you'd be concerned about the rate of exchange moving. If you have various bank accounts in other currencies, obviously you're concerned about the exchange rates. If you've got a foreign parent company, you're planning to enter emerging markets. If you own or operate subs, have expenses located in another country, the receivables we had mentioned, the foreign exchange translation gains or losses on financial statements, obviously exchange rates there would have an impact. If you're doing some sort of trade shows trying to get into other countries, if you're a logistics company, freight forwarder, you have sales staff globally. And lastly, one large part of the market which people don't have a tendency to think of, mutual fund traders. If you have your money, for example, in a Fidelity Europe fund, when that portfolio manager goes in and buys or sells shares, there's a foreign exchange trade being done on each side of that. So if this asset manager is buying shares of Siemens, the broker in Germany has to be paid in euros. So that would create a need for a foreign exchange trade. Likewise, if this was some sort of EPA fund, like a Far East component of that, if they were selling their shares in Sony, that would leave the asset manager long yen, and they would want to convert that back to dollars. So all of these dozen bullet points will give you a pretty broad spectrum of who would have foreign exchange.
You see that occasional commercial users will flop over and become speculators to hedge things that are out on the horizon that they might come about. It's just the way I look at it. It's just like hedging on resources. Say copper, for example. If you're going to have a need for copper a year out, you might want to hedge it with commodity pricing. Do you see that occasional users are getting into the speculation also?
It's a great question, and what we always try, Jack, is to give the most conservative advice for our clients and people that we get questions from. Really, if you don't do any hedging, you're more of a speculator than if you do hedging. Because if you do a hedge, you actually know what your cost is going to be. It'll be locked in. Mm-hmm. So we always recommend to clients and customers and business associates, if they have a risk, if you put a hedge on, you're actually taking away the speculation on the market movement. But we do have some clients that they have a tendency to think that they know where the rate's going to go, and they start to speculate a little bit, but we always frown upon that.
Well, it's interesting because as I started to look at your presentation ahead of time, I will admit it was kind of like Greek.
Right.
I hate to use Greek at this time, but anyway, it was like Greek. But when you really put it into the same context as copper or other precious metals, it really does. It's the same thing.
You're exactly right. I mean, money is a commodity, like copper or really any commodity that you might have as a cost in your business. So if you're in the agricultural space, if the price of wheat going up is going to hurt you, you certainly want to hedge that. And if you're a importer and you're buying product in Europe and the price of euros is going higher, that's a commodity as well, and you'd certainly want to hedge that risk. That brings us to the products, which we'll talk about some of those hedging things that Jack had brought up a second ago, but very basic rate of exchange, spot contracts, spot rates. You know, if you look in the Wall Street Journal, the Financial Times, at really any newspaper, if you're traveling, if you pop on the internet and see the rates of exchange, those are spot rates. So those are the most prevalent rates that you'll see. Spot contracts is how you use a spot rate of exchange. That's when there's an immediate need to deliver or wire one currency in exchange for another. So if you have a bill to pay, if something comes across your desk where maybe you need to pay an attorney in the UK, legal bill for £2,000, you call your provider, they make you a rate of exchange. In this case, to maybe tie in with the math we had before, you'd be on the offered side of the market. You'd agree to a price, and then those funds would be delivered in 2 business days. That's convention for a spot contract, how long it takes to go from point A to point B. East and West, so if you look United States to Europe or Japan, that 2-day is really set up just due to the time differences of when the banks are open. It can be done as soon as the next day, never same day. So convention is 2 days. If you need it in a hurry, you can get it there the next day. Spot contracts are the most typically used to send currency payables or to convert receivables into dollars. Getting into the hedging type products that you're either familiar with or will be, forward contracts are probably the most basic hedging instrument that's available in the market. It's an over-the-counter product. These aren't futures. Futures contracts in currency are traded on an exchange, and they have very specific days that they settle. They have very specific amounts in the contracts that can be bought or sold. Forward contracts are very customized down to the exact amount that you need to do, down to a very specific day that you need to do it on. So forwards are the most flexible tool that's available to hedge risk. Defined transaction today where one currency is bought or sold against another for a specific amount for delivery on a specific future date. A range of dates can also be used to do a forward. So if you know, say, between February 7th and, say, June 10th that you need to have a payment, but you're not quite sure when, a forward known as a window forward can allow you to lock into one rate of exchange for that period of time. And a window can either be done for a couple of days up to, say, maybe 6 to 9 months. If you don't have that much visibility in terms of your dates, you can create as wide a window as you'd like, really. Forward price are a little bit different from spot prices. There's yield curve differentials between the 2 particular countries that you're talking about, which spit out a forward point, if you will, and plus or minus the spot rate. That's how you come to an all-in forward rate of exchange.
How are points calculated?
Another good question. If you were to overlay the yield curve, U.S. Treasury yield curve on a graph, so envision that chart coming up on a graph on a piece of paper. Then if you were to take, say, for example, the Australian yield curve and put that on the same graph, you'll notice that there's differences in between the 2 yield curves in the bond markets. So what the forward points do is they equate that difference in curves, and that'll spit out a forward-point number depending on how wide they are and depending on whether the interest rate in the other country is above or below our interest rate. And our interest rates here are very low. So in Australia, they're very high. That's sort of why I picked that, because there's a wide discrepancy there. It seems most interest rates are heading to 0 regardless of the country, but depending on the differences and then the time on the curve, those are the points. So if you take your spot rate plus or minus the points, that will give you your all-in rate to do your forward contract at. That's a great question.
I want to interject the second code. The second CPE code is 25.
Moving along on the next slide, what are called non-deliverable forwards, or NDFs, in sort of trading lingo. It's basically the same as the plain vanilla forward that we just talked about in a little bit of detail, but it's specific to a particular country that doesn't have a more developed forward market or currency trading market. So if you think about China, or Brazil or some of the more the smaller emerging market countries that don't have a developed, not that China's small, but they don't have a very developed capital markets, bond markets, or currency markets. So the way to hedge exposure in those countries is to use what's called a non-deliverable forward. Basically, it's exactly what it says, in that the foreign amount isn't delivered. If you were to buy €1 million forward out 6 months because you have a machine to buy, at the end of that 6-month period of time, you would give your provider the wiring instructions. They would wire the euros to your counterparty. It would pay for the machine. So there would be a quote-unquote delivery of the euros to settle that forward contract. On a non-deliverable, if you were to hedge 10 million Chinese yuan, you would put a hedge on the rate of exchange, and then at settlement of that, depending on where the spot rate was, there would be a gain or a loss on that contract, and the settlement would be in U.S. dollars. Either your bank or provider would wire you U.S. dollars if you had a gain, or conversely, you would owe U.S. dollars to your bank or provider if you had a loss. So it really accomplishes the same thing. It takes the movement of the exchange rate out of the picture. You can lock in to a rate of exchange to make sure you don't have exposure to volatility in the market, but there's just no delivery of the foreign amount. Currency swaps, outside of forward contracts, are probably the most used product in the market. Basically, it's a simultaneous, meaning you do it at the same time, buying and selling of the same currency, so let's say euros here, for one date against another future date. So if you know, for example, that you've got a receivable in euro that you're going to get in 3 months, let's say you're expecting 500,000 euros to come in on a machine that you've sold, but you also know that in a year you're closing an acquisition where you're going to need the 500,000 to buy a company, let's say in Europe. The last thing you want to do is 2 separate foreign exchange trades where you go into the market today, you sell your euros, let's say you do it at 120, and then on down the road you've got to go back into the market and repurchase the same amount of euros. Let's say the rates moved up to 165. So basically you've just paid 45 points on 500,000 euros when you didn't need to. So from an educational standpoint, we try to make sure that clients understand that if you've got payables and receivables in the same currency, you can use currency swaps to insulate yourself from, 1, doing too many foreign exchange trades, and 2, more importantly, being exposed to unnecessary movements in the market. Structured products, this is a very broad product area. It's basically either a single option or a combination of options. The way I've defined it here would be financial instruments, usually involving an option, again, or a combination of options that can provide both protection against an adverse currency swing, while also potentially, depending on the product that you've chosen, allowing for upside to favorable currency movements. And that's certainly something that a lot of customers are interested in, is let's take our exposure off the table, and at the same time, if it were to move in our favor, maybe we can have a little bit of the upside. So option products, or structuring a derivative transaction, can allow for a lot of different outcomes. It can be fixed up front over a set period of time, depending on risk tolerance and cost. So usually when we talk about structured products, we usually give several options or scenarios, and then have clients pick what best suits their purposes. In terms of some lingo in structured products, they usually have a strike or strike prices. So it's very similar to the equity market, where if JP Morgan's trading at 35 and you want to buy a put at 30 to insulate yourself from the market moving lower, you could purchase a put with a strike of 30. If you thought it was going to 60, you could buy a call option with a strike of 60. Those will have a premium that you pay up front to help whoever it is that you're purchasing the option from. 4 examples that are the main products within the structured bucket: straight purchases of put and call options. Those are probably the most basic structured product. The premium is paid up front. Zero cost collars is a very prevalent product in this bucket as well. That's usually the purchase of one option financed with the sale of another option, so you could get down to zero cost. So again, using the JP Morgan example, if it's trading at 30, you might be able to buy a 25 put by selling a 35 call. So essentially you banded your risk between 25 and 35. your downside's to 25, your upside will be capped at 35. Average rate forward contracts, that's another product that we see a lot of in the marketplace. An example of where you might see an average rate forward used, if you're a Canadian company, for example, with daily expenses every day in Canadian dollars, but all of your revenue, 100% of your revenue is in US dollars, you've got risk every day to fluctuations in dollar Canada. So you could set up a daily fixing against a strike using an average rate forward. So the average part of this is an averaging of a daily, weekly, or monthly fixes against a strike. Participating forward contracts, this is another structured product that's used quite a bit, and basically it's broken down into a fixed rate hedge, which guarantees your downside. For example, as a buyer of euros, it'll protect you from the euro rate going up, but will also give you a percentage of the upside as the rate trickles down. So depending on what your risk tolerance is, depending on what you'd like to pay, depending on where the marketplace is, we could come up with, or any provider can come up with, structured products that will allow you to put a very tailored product onto your specific situation. Managing currency exposure, again, this is very basic here. I don't want to say obvious, but somewhat obvious. It starts with budgeting and planning. You'd like to get to how you can actually hedge your risk, and the first way to do that is you need to find out what risk that you have. So in terms of analyzing, the payables that you particularly have or receivables that you particularly have that are in foreign currencies, as you go through your quarterly or annually or biannually budgeting and planning process, that should be a big part of it. Exchange rates are much more volatile today than they used to be. Euro, for example, I think I've got some data in there in the back, but in 1 year, the volatility in that is 33%. So if you don't plan and budget, you could have a 33% swing in what you're either expecting to pay or receive in euro, which is quite a bit of a swing. So in getting into budgeting and planning, historical data that you've got obviously within your own institution can lead to a range of outcomes that will give a certain comfort level to the forecast. One thing we always talk about is how comfortable are you with the forecast that you have, because that will actually determine what hedging product that we will suggest to you at Bannockburn. If you're 50% certain, if you're 80% certain, if you're 100% certain, or if you're 10% certain, that will all spit out a very different sort of hedge that we will actually recommend. We're trying to get to a range of numbers that we can potentially hedge with some accuracy. So we're trying to get a very accurate budget and plan before we put on some sort of a hedge that isn't really going to match up what your risk is. So it's very important. In terms of forecasting exchange rates, it's a very, very difficult thing to do. There's lots of things that impact rates of exchange. On a very long-term basis, probably the largest thing that impacts the way currencies will move is the interest rate differential between the two countries in question. So if, say, the European Central Bank next week, there's a big central bank meeting on October 6th, if they cut rates 50 basis points, that would probably lead to a weakening of the euro. And we've seen the euro trade lower here in the last week or two as the market is anticipating that to happen. So in terms of budgeting exchange rates or looking at forecasts for exchange rates, we tend to have a view on the interest rate picture. I think that's very important. But day to day, there could be anywhere from 3 to 4 to 50 things that it could impact the way a currency will move and where it might be in 3 to 6 months. And in terms of getting a forecast for your budgeting and planning, using historical data and trends is very important. Talking to your bank or provider, getting their input is very important. So what we're trying to do, again, is to take the budget and planning information that you have in terms of your cash, and then going and adding a second piece of that, which is forecasting where we think the rate of exchange is going to be. And once we sort of get those two pieces of information, let's try to come up with a plan for how to hedge the risk that you actually have.
As we are in the economy that we're in, do you feel that most of the central governments or the central banks are trying to keep their currency as low as possible? Or do you think that they want to manipulate it or drive it to where it's going up?
That's a great question, and I think it's a very timely question, especially in terms of Greece, for example. If they were not in the euro, one thing they would be actively doing is to try to depreciate their currency because it helps their exporting. Not that Greece exports a lot of things, but
Olives.
Let's say if they did more than olives, that would certainly help them to come out of this because their products become much cheaper. And I think in the Eurozone, for example, I think they would welcome a much lower euro, but they're probably not going to come out and say that they'd like the euro to go down. So they'd like to sort of control the speed. So, and we've heard that in the United States for years. Standard line out of the Treasury Department is we prefer a strong dollar. I mean, every Treasury Secretary is always going to say that, but the policies that they put in place, they actually lead to a much cheaper dollar, lower interest rates, more borrowing. That's going to push the U.S. dollar down over time. So it's a very good question.
The last section on forecasting exchange rates, basically as you work with your clients, my guess is you're saying, hey, let's get an understanding of exchange rates so that you eliminate, you're taking enough risk as it is of buying products and figuring out if you can sell it. Let's take the exchange issue out of your risk component. And that's really what you're trying to do.
That's exactly right. I mean, if a company makes stamping presses, we want them to be focused on building a good press and finding customers to sell that to. And if they've got a specific margin, let's say it's 18%, for example, we just want them to get that margin and then move on to selling the next machine stamping press. We don't want them sitting around trying to guess on where the euro is going to go. So as we do these forecasting and planning budget meetings, we say, what's your margin? What are you comfortable with? Here's the rate of exchange. We lock it in now. You get this margin. So we'd like to take all those risks completely off the table and just let them do whatever it is that business does.
But isn't that first line of defense in that area would be to get a letter of credit, get money up front, get it paid in U.S. dollars? Isn't that the first line of defense?
Absolutely, and that's one of the sections we put in here. I believe it's the next section, which talks about exporting, is sometimes you don't have a choice to get paid in U.S. dollars. If there's two companies that are going after the same piece of business, and one says, I'm happy to take your currency, which is Swiss francs, and one says, I've never had a Swiss franc, I don't know how to take it, so I want dollars. If everything else is equal, the company that's in Switzerland probably wants to pay in Swiss francs. So certainly if you don't have to do foreign exchange, that would be fantastic, but sometimes it's you can't get to that. Yeah, yeah. The next slide, we talked just very basic in terms of hedging. What do you want to have set up within a hedging program from an internal perspective? When entering the hedges, they are derivative instruments, so who has approval to enter into these transactions? Does the program that you have, does it have to have multiple sign-offs? Does your board have to approve it? What type of goals do you want to have within that program? Those should be well-defined. And this is a living, breathing document. It should be changing on a yearly basis depending on what your needs are, where the market is. So it's okay to have updates to it frequently. In terms of goals, there's a lot of different goals that you might have. Do you want to keep the cost of payables within a set band for a specific period? Do you not want your cost to go up more than a specific percent? Is it 5%? Are you okay if it's under 20%, but if it's over 20%, that starts to get sort of painful. So there has to be some goals within your hedging program. And then you also want to mix into there, where is the market trading relative to our budget plan now versus in previous years? Is it really good, quote unquote, or bad, quote unquote, relative to what we need to do? Because that will also determine what sort of hedging that you want to do at that particular point in time. Then lastly, and we've said it a few times, how comfortable are we with the forecast that we've created? Is it a guess? Are we 100% certain we're going to sell this one machine and the contract's locked down? Are we 75% sure? That will dictate what type of hedging that we do. Based off of these goals that we kind of mentioned and the level of exchange rate in the market and where it is versus historical periods, then we go on to what sort of product is best suited to hedge with. And just very basically here, I want to show why you would use a forward contract, what particular set of circumstances that forwards would be a good idea to use in terms of hedging. if you're looking for an exact set outcome, and that's probably the most popular hedging tool that's available. Best used, I've got 4 different buckets here. It's best used when you're comfortable with the margins currently existing in your sale or project. So again, going back to the stamping press example, if you've got a deal with your customer, you're making 21% at today's exchange rate, and that's good. Let's just lock it in and move on to the next deal. So if you're comfortable with your margin, a forward contract, it locks you into that. That's the best thing to use to accomplish that. If the rate is better than budget or plan, if you've budgeted 12 in dollar Mexico to buy your pesos and it's at 14, it's best to lock in that huge gain because it's better than your budget and not try to be greedy and get something a little bit higher. It's best used when the market has moved a significant amount in your favor. So as a seller of euros, if it moved from 1 to 160, it's best to not try to structure a product that gets you to 165 since you've just picked up 60 points. So we would certainly recommend that you would use a forward contract in that instance as well. So lastly here, best used when there's some range of certainty as to the date the transaction will take place. So if you know it'll take place on January 11th, 2013, written in stone, forward contracts that we had mentioned earlier are very tailorable to a date. They're very tailorable to an amount. So the more exact, specific information that you have, a forward contract is usually the best way to go about hedging them. Options are the second most prevalent way to manage currency exposure. They provide a wide range of possibilities and outcomes depending on what is desired. I just gave a few basic ones here. There's probably 1,000 different scenarios, upside, downside, different strikes, different products that you can actually use. But in terms of our best used sort of buckets that we had with the forwards, if you were desiring to operate within a band of exchange rates, options can provide that for you. They could provide a floor of protection plus some upside movement to a preset level. This is also known as a collar. So if you would like to, if you're long euros, for example, let's say you've got 5 million euros coming in from a client and you want to protect 140, and let's say the rate's at 145, you could purchase a 140 put, and then maybe you have upside to 150 as you sell a 150 call, and that actually finances the 140 put. So zero cost collars, that's basically a put being financed by selling the call. Also best used when the market has moved significantly against you and you're not wanting to lock into a rate that gives no upside. As you are purchasing options, you are getting 100% of any upside. So in our same example, if you're a buyer of euros and the market's gone from 1 to 160, it's probably not the best time to lock in at the top. So we might recommend actually purchasing an option that is going to give you 100% protection, but if it were to drop back to 130, you get 100% of that upside. So that would also be best used when the market has really been significantly moving against you. Lastly, best used if you're okay spending some money on premium to gain the upside. Some companies, they have an aversion to spending money up front on derivative products. Sometimes that's a mistake, like in the previous example. I have a very hard time recommending people to do forward contracts when the market has really moved against them, when if they purchase an option, they could get the exact same level of protection and then 100% of the upside. So that's also best used if you're okay with spending a little bit of premium. Natural hedges, I just wanted to mention ways that you should be looking for, ways to not do foreign exchange trades. That probably sounds weird because I'm in the business of doing foreign exchange trades, but if there's a reason for you to have a receivable that offsets a payable or a payable that offsets a receivable, if you don't let those net together, you're going to be doing unneeded FX trades and unneeded hedging. So we always want our clients to really look at if they've got offsetting receivables and payables, they shouldn't be doing FX trades. Can you offset exposure with debt in another currency? This is another way to sort of hedge yourself. An example that I've got here, again, if you have a euro receivable, say for 5 million, maybe on an annual basis that you expect in, if you actually borrowed in euros, say for the similar amount, you've really formed a natural hedge against one another. So if the euro goes lower, your receivable is worth less, but as you're paying off your loan with stronger U.S. dollars, it's actually a benefit for you. So we like to talk about natural ways that you can actually hedge without entering into forward contracts or options. The last piece of this, again, is very basic, just growing sales through exports. As companies turn to new international markets, they're growing much quicker than the U.S., they're growing much quicker than Europe, so a lot of companies are in China, obviously Brazil, India, trying to get additional sales. Potential questions to ask, I just listed out here a half dozen to a dozen. How will you price the product? Is it going to be in U.S. dollars or in that particular country's currency? As exchange rates move, how do we reprice the product and when? Are we willing to accept foreign currency as payment? If we are, how do we collect the receivable? Is it going to be through a wire or a bank draft? Those are things to ask as you get clients in new countries. If you do have foreign currency that you're going to be receiving as payment, how do you hedge the risk that you're now taking on? What type of certainty, again, do we have in forecasting our sales? Because that will dictate how we hedge the risk that we now have. The last three of these, I think, are interesting to consider. Where are your competitors located? Are they other domestic companies that maybe you're requiring the same client to pay in U.S. dollars? Maybe you could get a leg up by accepting Canadian or Swiss francs or Indian rupees. That's a way to maybe get a little bit of an advantage against a competitor. And then if you know, how are the competitors handling the above-related issues? Do they hedge? Do they not hedge? Do they price their product in dollars? Do they change their price lists infrequently, frequently? Those are all good things to know to try to get an advantage. Lastly, if you are lucky enough to make some sales in other countries, a few things to initially consider. Are you going to hedge the risk associated with being a long foreign currency? Again, it goes back to managing your margins. If you've sold machine tool press in Canada at a certain rate of exchange and the rate has gone from 1 to 110, which is in the wrong direction, is that eating up all your margin, whereas now you have a loss? So you need to be very careful when you accept deals that you're aware of where the exchange rate is, how it's moving, and hopefully locking into that rate so you don't have an accidental loss or an accidental loss in margin that you thought you had up front. Second initial thing to consider, do you have any opportunity to offset, again, these receivables with a payable? So if you've got somebody paying you $1 million Canadian for a machine press over the course of a year, and you also have a sales office up there that has expenses, say, of $200,000, you shouldn't be doing a 200,000 Canadian dollar trade and also a 1 million Canadian trade. You should be trying to net those two things together, which brings us to the final 2 points. How do we collect these receivables that we're going to have? It is possible to establish your own foreign currency bank account to accept or hold foreign currency balances. This can be done through any bank or FX provider. Why would you do that? What sort of characteristics would require you to have an account? If you have a very high volume of incoming wires, that would be one reason that you'd want to have your own account. You can see who's paying you what invoices, that sort of thing. Do you have an existing need for outgoing payables? Again, this gets to trying to net as much currency together as you can. So if you've got an incoming receivable and you've got an outgoing payable in 6 weeks, you can leave that balance in the account, not convert it, and simply send it out. This will prevent you from having unnecessary FX trades. Do you have a need for lockbox services for checks? So if you're in Canada, for example, and you get in 100 checks a month, it's probably a good idea to have a lockbox. It's also possible, lastly, to settle your receivables through your foreign exchange provider's own foreign currency accounts. These are called nostro accounts in the business. So, for example, we have our own euro account where if you're only getting in 1 or 2 payments over the course of a year, your provider would give to you their instructions for their euro account. So you could give to your client the set of instructions. That way there's no need to have the expense and time and hassle of opening an account when you're only doing 2 payments per year. Again, wire transfer instructions would allow you to do that. That's the first bullet. The receivable, how is it converted? If you don't hedge, you're sort of at the mercy at whatever that day's spot rate is. So if that comes in on a Monday and the euro's at 130, you're selling them there. If it comes in on a Tuesday, it's at 135, you're going to sell them there. If you've done a preset hedge, when that receivable comes in, it would be cleared at whatever that preset hedge was as it was set up initially. Characteristics of not having your own account: if you've got a very low volume of transactions, you certainly wouldn't want to have the expense of having your own bank account. If you're not doing anything with checks, if you don't have payables, usually that dictates the use of the provider's account. So in terms of trying to set up your own bank accounts, usually we suggest to people that if there's payables and receivables, you should have one. If there's a high volume of activity, you should have one. If those things are very low in volume and activity, it's usually best just to use whoever you're using for your FX transactions to let them process the trades.
We covered quite a bit today.
It was a lot.
A lot there. But I have a couple of one question. I generally stay away from when people present the webinars. It's about the issues and not about necessarily specifically marketing your business. But I do have a question, and I'd like to interject it because traditionally these types of services have been provided through the banks, and obviously you guys came up through the banks.
That's right.
You've set this company up. How do you provide services directly to companies today? Do you provide your service through other smaller banks that don't have an international area? Maybe it's both of the above. I don't know. I'd like to.
That's a great question. Our clients, we go direct to companies. We deal with public companies. We have a few very large Fortune 100s that we have as clients. The meat of our clientele is small to mid-sized companies. I would say $15 to $400 million in revenue. I think the specialty piece that we offer is more hands-on service for a smaller type of company. If you're Procter & Gamble, for example, you've got 30 banks telling you that the euro is going down when they've got 6 guys that are paid just to watch that. Mm-hmm. So we like to go into the smaller companies and really be an FTE and help them manage their currency exposure without them having to go out and hire a staff of people to do this. So smaller banks, they're definitely clients that we offer the services to as well. So if you're a small bank that has a commercial client that needs foreign exchange to do, if you don't have your own desk, typically you have to go to an upstream bank like a Wells or a JP Chase. It doesn't really put a face to the transaction, and it's usually priced. Mm-hmm. Like there's no face to it, so the exchange rates are very uncompetitive, and then you're not really getting the service that you would be in terms of, I know your exposures, I know your cash flows, I know what your issues are, we'll come out and sit down with you and put a program together. Basically, you're just using that upstream bank to do the transaction. Mm-hmm. So that's something that we're active in talking to smaller banks as well. Those are good questions.
And I can certainly, obviously, it doesn't take a rocket scientist to figure out that as we move forward in the globalization of business, it's going to continue to be a more important risk to manage.
Absolutely.
It's going to be in almost every company's daily business. And again, it's a huge risk, and if you ignore it, you're not managing that risk.
That's a great point. And the volatility today, not only in currencies but in all markets, things move a lot quicker, a lot faster, with a lot more velocity than they did 20 years ago. So it used to take a year for the German mark to correct to whatever things were happening in the market. Now it can take days and weeks. So if you're not in front of that and hedging it, and if you're not actively watching it, you could have a lot of risk in your business that you don't want.
Okay. I'm going to give the last CPE code, then I'm going to ask a politically loaded question.
Okay, those are the best kind.
The last CPE code is 95. So again, if you want continuing education, send the form back and the 3 codes that I gave today, and we'll get that certificate out to you. And I guess the thing that I see, and I see a lot of critics of our government's trade policies, is the fact that they fail to act when our trading partners are manipulating their currency. Without naming any names, like China or anything like that, just give me your thoughts.
It's another really good question. It's a much more complicated issue than our politicians, and they understand it's a complicated issue.
Our politicians are capable of dealing with it?
Exactly. That's what I was trying not to say, but thanks for saying it for me. Yeah. For China, for example, and I'll mention that name, it's very important for us to have China buy our bonds. I mean, that's very important for us to help finance our deficit. And it's very important to have low interest rates here in the United States. And if we didn't have that, interest rates would be much higher. And if the peg on the exchange rate, for example, if that were to move lower, which would create a much stronger Chinese currency, it may be better for our exporters, but the tennis shoes that we go into Walmart and buy that are $8, they might be $70. So there is some benefit to having the exchange rate where it is. And from China's perspective, they have to grow their economy very quickly to keep their people employed. There's a lot of Chinese people running around over there looking for work. So if that exchange rate were to suddenly lurch lower, which would happen if it floated and which would happen if our politicians got their way, the growth of that country would slow substantially. And all of a sudden the products that the Chinese are buying and the global economy today is very dependent on China growing to kind of keep everything else going. If they were to stop, that would cause a lot of problems. So even though it's politically correct to say we need to have the exchange rate go down for competitive reasons, there's another side to that as well.
Yeah.
So that's a really good question.
That's interesting, and you're right. It is a complex issue. Well, our time is up today, but it's certainly been enlightening for me. I want to thank you, Mark and John, for coming in and sharing the information today with our clients and friends. I would recommend, if any of you have questions, Mark and John's contact information is on the screen right now, and they will certainly be happy to talk to any of you if you have any questions. So again, thank you guys for coming.
Thank you, Jack.
I want to let you know that we'd like your evaluation forms back, because we're always looking for appropriate topics to present. And certainly if you intend to get the CPE credit, we need that form back. In the month of October, we will be having 2 webinars. The first will be October 20th, and the subject, or the guest speaker, will be Bill Shirey, who is a managing partner from McGladrey Capital Markets. And we will be talking about the M&A trends that they see in today's environment. The webinar on October 27th will be on lean manufacturing, and I have the presenter. It's Mac McHenry, and again, he is also from RSM McGladrey, and the subject will be lean manufacturing. So I would like to thank everyone once again for listening in, and I hope we added value to your day. Thank you.